All right, today we're diving into a world that's all about fueling innovation, a world called venture capital. But here's the thing, it operates on a principle that sounds completely nuts, basically betting on failure in order to win big. So we're going to unpack that formula, follow the money, and see what it really costs to get a massive idea off the ground. It really all comes down to this one question, and it's a total paradox, right? How in the world do you get rich investing in companies that, for the most part, are practically built to fail? Well, the answer has nothing to do with being some kind of genius who can pick the one winner. It's all about playing the odds. It's just math. You see, the whole secret to cracking the VC code is just a complete shift in how you think. You have to stop thinking about individual companies, individual projects, and start thinking like a portfolio manager. And trust me, this one little idea is the engine that drives the entire industry. Okay, think about this for a second. A normal project manager, they live in constant fear of a single failure. For them, the goal is 100% success, every single time. A venture capitalist, a VC, works on the exact opposite principle. They fully expect most of their investments to just go up in smoke. They just need a single home run, to cover all those losses and then some, making the entire fund a massive, massive success. So how do they basically stack the deck to make sure they get that one home run? Well, they do it by treating startups like a series of coin flips. Yep, simple as that. Each investment is a toss. It might come up heads, it might come up tails, but one outcome doesn't have any effect on the next. And when you do this enough times, probability actually starts working for you. Let's actually look at the numbers here. Say a startup has a 25% chance of succeeding, which, by the way, is pretty optimistic. If you bet on just one company, you've got some pretty terrible odds. But watch what happens when you start to build a portfolio. Invest in 10 companies, and your chance of getting at least one winner just skyrockets to 94%. And at 100 investments, it becomes a near mathematical certainty. And that's really the big idea here. The more separate bets you make, the lower your chance of a total wipeout becomes. VCs aren't trying to avoid losers. That's not the game. They're trying to build a portfolio that mathematically guarantees a winner. It's not about predicting the future, it's about mastering probability. Okay, so if that's the math, who are the people, the institutions, that actually make this whole machine work? Let's follow the money, starting right from the source. So the money that fuels venture capital comes from what are called limited partners, or LPs. And we're not just talking about a few wealthy people here. We're talking about huge, massive pools of capital. Think about the pension fund that manages a teacher's retirement, or a big university's endowment, or a major insurance company. They're the silent partners, and they are providing all the fuel for the fire. Now, for these LPs, venture capital is just a tiny, super high-risk slice of a much, much bigger and more conservative pie. It might only make up 5% of their total assets, usually filed under alternative investments. And because this little slice is so much riskier than everything else they own, like stocks and bonds, they demand, absolutely demand, that it produces gigantic returns to even be worth the trouble. And when I say massive, I'm not talking about regular stock market returns. LPs are looking for something like 25 to 35% per year. Over the lifetime of a fund, that translates to a goal of returning 10 times their initial investment. This unbelievable pressure for a 10x return is what dictates every single move a VC makes. And the people on the hook for delivering those 10x returns, those are the general partners, or GPs. These are the venture capitalists that we always hear about. Their job is to raise the money from the LPs and then go out and find the entrepreneurs, make the deals, and manage the whole portfolio. Now, a GP's job is way, way more than just writing checks. They are constantly out there sourcing deals through their networks. They have to somehow pick that one potential winner out of hundreds and hundreds of pitches. And then they have to actively manage that investment, which often means taking a board seat and mentoring the founders. And finally, maybe their most important job, harvesting the investment, helping the company get bought or go public, because that is the only way anyone gets paid. So that brings up a good question. How do the VCs themselves actually get paid for all this work? Well, it all comes down to a special compensation structure that's designed to perfectly align their goals with their investors. It's famously known as 2 and 20. So the 2 refers to the management fee. This is about 2% of the total fund, paid out every year. For a big fund, this covers all the salaries, the rent, keeps the lights on. But the 20, that's the carried interest. That's where the real money is made.
After the LPs get all of their original investment back, the GPs get to keep 20% of all the profits. And the key thing here is no profits, no carry.
This quote just nails it. It gets right to the heart of the whole model. The management fee pays the bills, sure, but that carried interest is what creates life-changing wealth for these VCs. This whole setup forces them to just swing for the fences on every single investment. A small, modest success, that's just not going to cut it. It won't generate the kind of profits you need to get that 20% carry.
Okay, so let's flip the scripts for a minute. We know what the VCs need, but what does that mean for the entrepreneurs sitting on the other side of the table? What's the price they have to pay for all this high-octane fuel? VCs are basically hunters, and they're looking for a very specific kind of prey. They need a plan with a massive upside. We're not talking about a stable little family business. We're talking about something that could plausibly deliver a 100x return. The business has to be able to scale incredibly fast if you pump it full of capital. And maybe the most important part, they need a founder who gets the deal. A founder who understands that they will very likely end up owning a small piece of a very, very big pie. So that's the fundamental bargain right there. The entrepreneur gives up a huge chunk of ownership and a lot of control over their own company. In exchange, they get the capital, the expertise, and the network connections to take a shot at building something truly enormous, something they could probably never build on their own. And that leaves us with the ultimate question, the one every founder has to answer for themselves. It's really the core dilemma of the entire venture capital world. Is giving up all that control worth a shot at building something monumental? For some people, the answer is an obvious yes, but for others, that price is just way too high. And there's no single right answer, which is what makes this whole world so incredibly fascinating.